Welcome back to Investing Talk podcast. We're about to embark on, well, a fascinating journey today, unpacking a question that's definitely on a lot of investors' minds. Is Oscar Health a good time to buy now? We've gathered quite a bit of information looking at everything from, its recent financial turnaround, which is pretty remarkable, to its stock's incredibly wild ride just this past June 2025. Our mission really is to pull out the most important nuggets of knowledge here and help you understand the whole picture so you can figure out what this all means for your own investment thoughts. Before we get into all that, though, if you're finding value in these deep dives we do, please take a moment to subscribe, maybe like this episode, leave a comment with your thoughts too. And hey, if you're feeling extra generous, consider buying us a coffee to support the show. Your engagement, it really helps us bring you more of these detailed analyses. Okay, let's explore this then. Oscar Health, a technology driven health insurance company that just hit profitability. Which is big news, but the stock has just surged dramatically, like over 50% in just 5 days this June. So, what exactly does all this mean? This growth, this pivot, the story of Oscar Health has been, well, quite something. For years, they were losing money pretty consistently. But 2024 marked their first profitable year. That's a huge pivot. Can you walk us through that financial turnaround? What happened there?
It's really the speed, I think, the speed and scale of their financial improvement that's fascinating here. You see Oscar Health achieving a net income of $25.4 million for the full year 2024.
Yeah.
Compare that. That's a huge swing from a loss, a big one. $270.7 million in 2023. And it didn't stop there. Q1 2025, their net income just kept impressing, hit $275.3 million. Compare that to $177.4 million in Q1 of 2024.
Yeah.
This isn't just, numbers changing. It feels like a fundamental re-rating of their business model, going from burning cash to actually, well, being viable.
That is a profound shift from a deep red to black and so quickly. What would you say are the core drivers behind that turnaround? What made it happen?
The drivers seem pretty clear, actually. It boils down to exceptional revenue growth and alongside that, a really significant expansion in membership. Look at Q1 2025 revenue, $3.05 billion. That's up 42% year over year. That's huge. Annually, their revenue jumped from $5.86 billion in 2023 to $9.18 billion in 2024. That's a 56% increase.
56%.
Right. And this growth, it's largely fueled by getting more members. They hit approximately 2 million members as of Q1 2025. That's up 41% year over year. It's sort of like watching a tech company finally hitting that growth stride, but doing it in healthcare insurance, which usually moves slower.
Okay, so the top line numbers are impressive, membership's booming, but what about efficiency? Are they managing costs as they scale up so fast?
That's a great question. And yes, operational efficiency has improved quite significantly. Their SG&A expense ratio, that's, selling general admin costs, basically the cost of running the business outside, claims it hit a historic low for them, 15.8% in Q1 2025.
15.8, that's quite low.
It is. It's down 260 basis points, 2.6 percentage points from the year before. That's a key sign they're running leaner, which obviously helps profitability. Now, their medical loss ratio, the MLR, which is how much premium goes to actual medical claims, was 75.4% in Q1 25. That's a little higher than the prior year, but still well within what you consider manageable ranges for the industry. Overall, operating margin improved 110 basis points year over year to 9.8% in Q1 2025. And adjusted EBITDA, that operational profit measure, hit $329 million. That's a $110 million improvement in just that quarter.
So operations look stronger, more efficient. Is that showing up on the balance sheet? Do they have a solid financial foundation now, or did they take on debt for this growth?
Well, if you connect that operational picture to their balance sheet, it looks frankly quite robust, especially for a company that was, losing money not that long ago. They hold about $2.99 billion in cash and short-term investments. That's a nice cushion. Total debt is only around $359 million. So that leaves them with a strong net cash position of about $1.88 billion.
$1.88 billion net cash. Okay.
Right. And their debt-to-equity ratio, just 22.4%. This is pretty conservative leverage. They aren't borrowing heavily. Plus, they generated significant cash from operations, $1.22 billion over the last 12 months. Free cash flow of $1.19 billion. That gives them a lot of flexibility.
Okay, this sounds incredibly positive. A dramatic turnaround, strong financials, but let's be real, healthcare insurance is a tough market. You've got giants like United Health Group, Anthem. How does Oscar Health actually stand out? What's their competitive edge in that kind of crowd?
That's the key question for their long-term story, isn't it? How do they compete? Oscar positions itself fundamentally as a tech company operating in health insurance. That's their differentiator. They talk about a 98% claims auto-adjudication rate. That means almost all claims get processed automatically, no human touch needed. That's huge.
98%.
And they've implemented over 20 AI use cases across the business. What that means, practically, is faster claims for members, lower admin costs for Oscar, and using data to manage costs, and maybe even personalize care, better than some older systems allow.
So they're genuinely trying to innovate using tech in a, let's face it, pretty traditional industry. How big is their reach now, and what are the plans to scale this model?
Right now, they hold about 7% of the total Affordable Care Act market share. That's across 18 states, so it's a decent footprint. But what's compelling is their plan. They aim to expand significantly, adding 150 metro areas over the next 3 years. They're focusing on individual and small group markets and also making a push into Medicare Advantage, which is a big growth area.
Okay, so impressive growth, improving efficiency, tech differentiation, and as we said, the stock has just rocketed. What do the valuation metrics tell us now, especially after jumping 50%? Does the price still make sense, or is it getting a bit frothy?
Yeah, that surge definitely pushed the valuation up. Oscar Health is trading at a price-to-earnings, or PE ratio, of around 67 times its trailing earnings. And looking forward, based on estimates, it's even higher, maybe around 88 times next year's earnings.
88 times forward earnings.
Right. To give context, you look at United Health, maybe you see a PE in the low 20s. So Oscar's is significantly higher. That premium clearly reflects the market's very high expectations for growth for that tech angle paying off. However, if you look at price to sales, market cap versus revenue, it's around 0.51. That actually looks, well, reasonably fair for a high-growth healthcare tech company that's just turned the corner on profitability. So it's a bit of a mixed picture there.
That PE definitely signals high hopes. What are analysts projecting then? Are they seeing this growth trajectory continuing for Oscar Health?
They are. Analysts project significant earnings growth. They see earnings per share going from around 69 cents in 2025 up to potentially 196 per share by 2027. And revenue is also expected to keep climbing from maybe $11.3 billion in 2025 to roughly $13 billion by 2027. That represents a pretty solid annual growth rate, around 12.5%. So the consensus view is, yes, this growth story has legs.
Okay, but that price action recently, over 50% in 5 days, hitting over $22. It's been wild. For people watching the charts, what are the technical indicators saying? After a run like that, is the stock overbought? Is there still momentum?
The technicals are giving some mixed signals right now. The RSI, the Roller Index, it's hovering around 69 to 71.
Which is high.
Which is high.
Yeah.
That typically suggests overbought conditions, hinting a pullback might be due. But the NCD, another momentum indicator that's still showing strong bullish momentum, around 0.40. So buying pressure is still there, and the stock is trading above all the key moving averages 10, 20, 50, 200-day. That's generally a bullish sign. Volume has also been huge, way up, over 20 million shares traded on some of those surge days. Confirms strong interest, but also high volatility.
With that mixed technical picture, what are the key levels? Where's resistance? Where might support kick in if it does pull back?
Key resistance levels to watch are that 52-week high, which was $23.79 back in September 2024, and also the recent intraday high around $22.78. Those could act as ceilings. On the support side, immediate support might be found around $18.77. Below that, there was prior session support near $16.11. And major support looks to be in the, say, $14.95 down to $13.95 range. Those are levels where buyers might step back in more strongly.
And how are the Wall Street analysts viewing Oscar Health now? Beyond the charts, what's the broader sentiment? Is it all bullish, or is there some caution creeping in?
Sentiment on Wall Street is also pretty mixed, actually. It mirrors the technicals in a way. While a good chunk, 72% of analysts, rate the stock a buy, some recent actions show caution. Piper Sandler, for example, kept an overweight rating but cut their price target from $25 down to $18.
Down to $18.
And Wells Fargo downgraded Oscar Health from overweight to equal weight, setting a $16 price target. The average analyst price target right now is around $18.56, which, interestingly, after this recent run-up, suggests potential downside from where the stock is trading currently.
What about the buzz online? Social media, with that kind of price jump, is it getting attention from retail investors?
Oh, absolutely. Oscar Health has definitely gained significant attention. You see discussions on platforms like Reddit calling it a meme stock because of that rapid, volatile price move. Retail investor search interest is way up, something like 217% in the last 30 days. That points to a lot more speculative interest, more public awareness. And, separate from that, there have been some corporate changes too. Key executive hires like Janet Liang coming in as EVP and president of Oscar Insurance back in February 2025. Also some departures, things to keep an eye on.
So, looking ahead then, what are the key things coming up that could really move the needle for Oscar Health, near term and maybe longer term?
Near term, all eyes are on the Q2 2025 earnings report. That's expected around August 6th. The consensus estimate is for $0.34 EPS. A beat or miss there could definitely impact things. Also, the upcoming ACA, Affordable Care Act, open enrollment period later in the year, that's critical for membership growth. And, always potential regulatory updates. Changes to ACA subsidies or Medicare Advantage programs could affect the landscape.
And longer term, beyond the next quarter or enrollment period.
Longer term, the catalysts are really about executing their strategy. That geographic expansion plan, doubling their footprint over 3 years, that's huge if they pull it off. Continued growth in Medicare Advantage is key. And further integration of their tech, AI, automation to keep that efficiency edge. They're also talking about scaling their tech platform to offer it to other healthcare organizations. That could be a whole new business line eventually.
Makes sense. But every investment has downsides too. What are the main risks we should be thinking about with Oscar Health?
There are several layers of risk, for sure. Stock-specific first. Valuation is a big one. That high PE makes it vulnerable if growth slows or they miss earnings. And that recent 50% plus jump in 5 days, that screams speculative activity, which brings risk of a sharp correction. There's also significant short interest. Almost 11% of the float is shorted. That can add fuel to volatility, both up and down.
11% short, wow.
Then you have sector risks. Regulatory changes are always a wild card in healthcare. Intense competition isn't going away, and medical cost inflation, keeping that under control, is a constant battle. And finally, macro risks. Interest rate changes could affect them, an economic downturn might impact insurance enrollment or affordability, and political risks around healthcare policy, especially after elections, are always there.
That's a really thorough look at the risks too. Okay, let's try to bring it all together. The big question we started with, is Oscar Health a good time to buy right now after this huge run? What's the takeaway for our listener?
Well, Oscar Health definitely shows strong fundamental improvement. You can't ignore the revenue growth, that profitability turnaround is impressive, and the balance sheet looks solid. However, that recent 50% price surge, you just can't ignore that either. It's pushed the valuation to levels that look frankly concerning in the near term, creates significant risk right here, right now. So for long-term investors, people looking out maybe 3 years or more, Oscar Health could still be suitable. The fundamentals, the growth story, they could support further expansion, even with bumps along the way. But for short-term traders, it looks like high-risk territory currently. You've got extreme overbought technical readings, high volatility. Timing an entry or exit would be very challenging. If I had to put a number on it, balancing everything, maybe a 6 out of 10 overall. For a more conservative entry point, the range around $16 to $18 seems more reasonable. That lines up with where analysts, on average, see the value.
So wait for a pullback, potentially.
Potentially, yes. An aggressive entry might be considered maybe $19, $20 if it dips there. But generally, jumping in above $21 right now seems ill-advised, given the overbought signals. For long-term investors, patience might be key. Waiting for that $16, $18 range, or perhaps using dollar-cost averages given the expected volatility, could be prudent. The real focus should be on whether the company keeps executing its growth strategy, not getting caught up in these wild short-term price swings.
That's a really clear, nuanced perspective. So what does this all mean for you, our listener? Think about Oscar Health's journey from losing money to being profitable, high growth, tech focused, but in a tough market. And now it has this meme stock energy around it. What does that mix strong fundamentals, high growth, but also intense volatility and speculative interest tell us about the market's current mood, especially its appetite for tech disruption in old school industries? And maybe how does that influence your own investment philosophy as you navigate this market? Something to think about. We really hope this deep dive into Oscar Health has given you the insights you need to feel well informed, whatever you decide. Thank you for joining us on Investing Talk Podcast. We look forward to our next deep dive with you.